Hello, everyone. Dave Keller here with StockCharts.com, and welcome to the final bar. This week, we're doing a very exciting special event called the Top 5 Charts of 2021. I'm going to go through 5 particular charts that I think tell the story of the market environment in 2021. It has been a crazy ride, an uncertain ride, but the charts can tell us a great deal about the dynamics of this market in this year and also for next year. Ladies and gentlemen, this is the final bar. Hello, everyone. Dave Keller here with StockCharts.com, and welcome to the final bar. It's a pleasure to be with you sort of remotely, I guess, this week. We've taken a couple weeks off live programming here at the end of the year, but very excited to share with you some content that we think should help you to make sense of this market environment. What we're going to be doing this week is looking at the top 5 charts of 2021, and I'm going to share with you one by one why I think these tell the story of this market environment, how we can use them to make sense of this uncertain market in uncertain times, but also start to plan ahead for next year. Because I think a lot of these charts may be the same 5 that I think are going to be the most important to watch going into next year. And to be honest, right, there are an infinite number of conflicting themes and ideas. We have so many different narratives to make sense of, with coronavirus, with inflationary pressures, with the Fed, in infrastructure spending, stimulus bills, et cetera, et cetera. There's so much. But at the end of the day, I would argue that technical analysis charts can help you cut through all of that noise, right? Narratives are great because they try to help us try to make sense of the world around us. But in terms of developing an investment thesis, it's tough to do that around a narrative, particularly when there are so many out there. What the charts will tell you is how the market is aggregating or reacting to all those potential influences. And at the end of the day, buyers and sellers come together at certain prices, and those turn into trends. And that is what we can absolutely track and rely on and understand a little bit better. So what we're going to do today is go through the 5 charts that I think tell the story of 2021. We're going to do it one by one, and we're going to start with the market trend model. So this is a chart that we actually use every Friday normally on the final bar, and it's the first chart that I look at every single day. I actually did a webcast earlier in December for market misbehavior, where we focused particularly on the market trend model, how to develop this, or how I developed it, and how to create your own a systematic model to understand the market environment. And the reason why I have a systematic model like this, what I call the market trend model, is my process tends to be fairly subjective, right? My process involves looking at hundreds of charts a day, thousands of charts a week, and trying to understand the markets by visually, digesting as much information as I can about price and trend and momentum. But at the end of the day, a subjective process, it's very easy, I would argue, for biases, for uncertainty to creep into your process. It's hard to have, you have to have a lot of discipline to stick to a consistent routine of analyzing charts. And I have found using a systematic trend following model in the background is a really good way to help keep me honest. I read early on in my career as I was learning about the markets, and I forget who particularly says, I feel it's like a William O'Neill thing or a Ned Davis thing or something, but 85% of a stocks movement is driven by the overall market environment. A rising tide lifts all boats is another way I've heard it said. And so this market trend model is an attempt to understand that, or to acknowledge that. What are the tides, right? Overall, is the tide going out? Is the tide coming in? What does that tell me, about the likelihood of stocks going up or down? Tom Dorsey, who's famous and has done incredibly well promoting point and figure charting and momentum investing and systematic quantitative models based on price momentum. He always related it to football and said, is the offense on the field or the defense on the field? And he used, uses point and figure charts primarily to make that assessment. But at the end of the day, it's if the offense is on the field, then you're more likely to score a touchdown. You can still score a touchdown if the defense is on the field. It's just a lot less likely, right? You're much better. You have much better likelihood of doing well if the offense is on the field. And that's what this market trend model is designed to do. Is the offense or the defense on the field? And all my other analysis should be starting from that point of reference, right? That should be my starting point to help me make sense of these things. Having said that, here's what the market trend model is doing. I'm looking at weekly data. So I'm actually looking at the last 5 years here. So 2021 is just this, 20% to the right here. The long-term model, medium-term model, short-term model are all driven off of weekly exponential moving averages, just different combinations of those averages to better quantify these different timeframes. And I have these timeframes as fairly loose. For me, when I say short-term, it's about a couple of days to a couple of weeks. Medium term is a couple of months to a couple of years. Long term is a couple of years and beyond, right? Sort of a very long-term time frame. Now, for you, those adjectives, short term, medium term, long term, could have very different time frames, and that's totally fine. These are just the general ways that I think, as a long-term investor, those are the general time frames that I want to sort of be thinking on. And I don't really go shorter than a couple of days. I don't really look at a lot of intraday charts because that's not really the game I'm trying to play. I'm trying to play more of a longer term structural view of the markets. So let's look at what the evidence has said. So if we start in 2020, you can see the drop in 2020. All three of these components of the model were all negative, which makes sense, right? Severe drop, undercutting moving averages, undercutting previous lows. That makes sense, would be in a downtrend. All three of them turned positive sort of in the March, April, May, June timeframe, depending on how quick they are. So the short-term model turned back positive end of March. In early May, the medium-term model turned positive. The long-term model turns positive in June. For me, the medium-term model, by the way, is my main risk-on and risk-off measure. This is the main, measure that I have of overall. Should I be thinking more risk-on and looking for long ideas, or risk-off and thinking about defense or short ideas, or being more cautionary? So what happened since then, and when really going into 2021, we think of this market in a couple different phases. Really, there was this disbelief phase as the market initially came out of the March 2020 low, that falling, that sort of a V bottom, the falling knife. As we came on, it was sort of this process as investors, disbelief or did not believe that the market was really going higher. Eventually, there's this acknowledgement, there's this recognition that the trend is actually positive. And I think for most investors, that kind of happened in the April, May, June timeframe, depending on how long you waited to recognize that uptrend. And what's funny is, even if you waited until June, you still had plenty of upside. And that's what 2021 has been about. After October, November of last year, which is sort of that, or September, October, sort of that consolidation period, that coil pattern before you broke out. From there, the market was very, very strong. And really going into January, you had the S&P finishing in a position of strength, the NASDAQ making new highs going into the end of the year, overall setting up for a pretty strong market environment. And that is pretty much, from a high level, what we saw. As we get to some of the other charts, we'll see how that was not actually the case for a lot of things, but certainly for the S&P as a whole, it was a nice, fairly consistent uptrend. So the long-term model remained very, very positive. The medium-term model, for me, remained positive as well through the course of 2021. It's the short-term model that gave some random little bearish indications, never for more than like 2 or 3 weeks at a time. And just most recently in late November was the longest that the short-term model had been negative for me. But that's more of a tactical read for me. That's just more recognizing, illustrating the short-term trend. The medium-term model is my main measure. Now, the reason why I wanted to start with this as one of the top charts of 2021 is because I actually changed this model in 2021. My previous model actually used the weekly MACD as this component, and I can switch it very quickly just so you can see. That's sort of this one. So now I've changed a little bit. Ignore the labeling, but this is basically what I had been using as my medium-term model, was the traditional weekly MACD, or weekly PPO, which is a trend-following device that Jerry Apple created years ago. The MACD PPO is an adaptation of that, using percent changes instead of absolute changes. But other than that, the signals are almost identical. So the medium-term trend model for me used to be when these lines would cross up and down through one another. And what troubled me about this model in 2021, which is why I think this is such an important chart to start with, is because if you look, it actually gave a sell signal in May of 2021 and then remained bearish even through today, right? In the middle of December, as we're coming off of all-time highs yet again, the medium-term model has remained negative. So it troubled me through the summer and into the fall when that medium-term model remained bearish, even though the S&P was going higher. And when I originally put this model together and designed it and tried to, come up with a model that would, systematically track what I would visually interpret looking at the charts myself, there was now a disconnect, right? The medium-term trend felt very positive to me as the market was going higher and higher, but the model was actually telling me to be bearish. So I turned very cautious in May and June. That didn't play out. It was a brief pullback in May, but from there, the market kept going higher. So I actually changed the model, reset, and came up with this new setting. And now I'm pretty confident, having gone back and tested it, having looked at how it performed in different market cycles. I think it's a better representation of that medium term, and it's fitting my purposes a little more closely. So I started with this just to illustrate that overall the trend in stocks was overwhelmingly positive. If you look at the high level indexes, a little later we'll look at some different ratios and sectors to understand how it was very much a rotational year. But even though leadership rotated quite a bit, this was a strong year. One of the strongest consistent uptrends. Reminded me a lot of 2017, which is on the left side of this chart, where you basically just spent most of the year in this consistent uptrend. And while there were plenty of narratives, plenty of reasons why the market should not go higher, 2021 was a reminder to ignore narratives, and they're interesting, they're great, and they're fun to talk about. And it's good water cooler discussion. But in terms of an investment thesis, follow the trend, and overwhelmingly the high level trend has been positive. For me, going into 2022, as long as that medium-term trend model remains positive, it reminds me to stay overall risk on and to think about upside opportunity. And as always, pay attention to stops and risk management. But as long as that model remains positive, it's telling me to not take my foot off the accelerator too much until the trend indicates that. So that is chart number one. Chart number two is kind of a simple one. It is the S&P 500 chart. It is a daily chart of the S&P 500. And you may be wondering, why are two of my charts just the S&P? Early on in my career, Ralph Acampora, one of my early mentors, said, if you have one chart to understand the S&P 500, it should just be, or understand the market, it should be a daily chart of the S&P 500, just the price. And it was a great reminder, a great learning experience talking with him early on, and as much as I can to this day, because it's a reminder to keep it simple, to focus on trend. And when the trend is positive, remain bullish. When the trend is negative, be more cautious. But it has to start with answering that question about the trend. We looked at the market trend model first. You saw the overall strengthening in stocks. When I'm looking at the daily S&P chart, now you get a little more of the nuance, a little more of the noise of 2021. This was a frustrating year. And I will tell you, there are a lot of market environments that can be frustrating. Deep bear market phases, I've gone through a couple of those so far, and those can be super frustrating because it feels like nothing's working. You wonder why we're even doing this. Why are we investing in stocks ever at all? And it can be a morale killer for sure. Grinding markets that go higher can be frustrating too. And that's why I think it was most frustrating about 2020, 2021. There have been historical periods as well. 2014, I think, comes to mind, where the market overall was positive, but the top two sectors were utilities and real estate, which is not what you'd expect, right? When the market is doing well, you'd expect fairly offensive sectors, something like consumer discretionary or tech, or like healthcare and materials, industrials. A cyclical sector would do well in an established bull market that keeps going higher. 2014 was overall a strong year for the S&P, but the top two sectors were fairly defensive. It was utilities and real estate. And there are a lot of reasons, don't have time to go into, as to why that actually happened. But if you look back at the data, that's what happened. And so that was a frustrating year, because even if you knew ahead of time, you had perfect foresight and you knew that the S&P was going to be strong in 2014, you most likely would not have bought utilities and real estate. You would have bought things like tech and consumer. You would have underperformed those names, and you potentially underperformed the market as a whole. So one of the things we would talk about in my Fidelity days, or the frustrating markets, would be a bull market that you don't get paid for, right? You get the market call right, but you don't have the right positioning to actually profit from that or benefit from that. I think a lot of investors got trapped with that in 2021. The S&P overall was strong. If you look at the relative performance of small cap stocks, actually not, actually fairly frustrating, right? It was, small caps in general were flat this year. And so as a result, I think you have this situation where, the markets went higher. The NASDAQ can made fairly consistent higher highs through much of the course of 2021. And the S&P 500 did as well, but depending on what you actually owned, you did not get that experience. I'm actually, as we're talking, I'm going to add the IWM on here, which is the Russell 2000 ETF. We're going to make that the same height. There we go. Now I think this is the chart I want to show here. I was going to say we'll make this the actual chart. Make this a better color. Blue. Here we go. So here's chart number 2. Now, and the reason why I'm putting this on here is to show that the S&P consistently strong, which is super impressive. And we'll get back to some of these pullbacks along the way. We saw some divergences along the way, which we'll get to. But at the bottom, I wanted to show just this experience, right? What was your experience as an investor in 2021? And I would argue, depending on what you owned, it could have been a very frustrating year. Small caps actually rallied in the first month or two, right? In January and February continued the strength in November and December, and small caps felt like a great leadership space. But if you look from February to where we're at the end of December of 2021, you've literally gone nowhere. You're actually net down a little bit from early February to where we are today. So literally it's been sideways. You have gained nothing. You haven't lost much, but at a time when the S&P and the NASDAQ, the mega cap trade is working so much, if you own sort of the average stock, something maybe a little smaller mid cap type of name, you probably didn't do nearly as well. And I think that's one of those problems or challenges a lot of investors faced in 2021, getting the market call right potentially, but not getting paid for it. Now, if you look at some of the pullbacks through the course of 2021, I would say a couple other observations from this daily chart and why it deserves to be one of the key charts of this year. We didn't have very severe pullbacks at all. The deepest pullback we had was September into October of this year, which is about 6%. Here so far in November into early December was just over 5%. Not too bad. So this year actually had some of the least amount of pullbacks. Now, granted, the year's not done yet, and we could sell off into the end of the year, which would be unusual, but it's possible. It has happened before. And so we could get a 10% pullback going into the end of December, beginning of January. I don't think that's likely, but it is absolutely a possibility. So we may be faced with a situation where the deepest pullback was about 5 to 6%, which again is below. Usually you get a good 10+% correction or pullback drawdown in the normal course of trading. This was unusual that it was pretty light. What was also unusual is how consistently the 50-day moving average basically became the play. If you ignored everything and just bought every time the S&P touched its 50-day moving average, overall you would have had an incredibly good average cost basis for your trading in 2021. You would have accumulated on the dips. Maybe you would have had a one bad trade in September, but you became whole about 4 weeks later and have continued to improve from there. So this, I think much of 2021 was basically was about an awareness of where the 50-day moving average was and recognizing that consistent pattern. September, October was a little different. This was maybe the most unique period where you had a change of character, where the S&P finally broke down, undercut its previous swing low, undercut the 50-day moving average. But again, it was a fairly resilient market. Buyers came in and pushed higher. We're going to look at a little later. I think actually the next chart we'll look at is an illustration of that buy on the dips mentality that I think was prevalent through much of this year. But the last thing I want to talk about on this chart are the divergences. We've had 4 bearish momentum divergences where the price was going higher and the momentum was actually sloping downward. Once in January, February, second in April and May, 3rd July into August, and then the 4th November into December, where we're at today. We're recording this on December 17th on Friday. So what's worth noting is bearish momentum divergences usually are a really good indication of market disruption, an indication of potentially an exhaustion of buyers. The fact that the uptrend has run out and you start to see a pullback. But if you look, what the story of 2021 was minimal pullbacks after these bearish divergences. I remember in January, February, getting super cautious when you had this big glaring bearish divergence as the S&P had made continuously new highs every month. We only had about a 5 to 6% pullback. April, May, it was only 4%. In July, August, we only pulled back around 3%, 4% in the middle of that pattern, but never really sold off afterwards. Maybe a delayed pullback a little bit later of 6%. And then here, so far, we've dropped about 5% with this bearish momentum divergence November, December. That could, it's continuing to play out actually here in mid-December, where you keep seeing the market trying to test 4,700 on lower momentum. So, in general, a healthy bull market phase in the short term sees improving price and strong momentum, right? So momentum remaining strong. An exhaustion signal is often the market keeps going higher, but instead of the momentum remaining elevated, it starts to come off a little bit. That's what I think we're potentially seeing here. So as we go into 2022, this is the story. S&P 4,700, if that can be eclipsed, do we break a risk level of 4,500, 4,550? Does this bearish momentum divergence resolve itself higher, or do we follow through to the downside? Those are all questions that need to come from this chart. And also small caps. Do you finally see an emergence of small caps? Here in early November was an indication that small caps were actually starting to lead. But so far that has been repelled, and we're back to a stagnating sideways experience. So this chart is all about the resilience of the uptrend, the brief pullbacks, the minimal drawdowns, the momentum divergences, which have been concerning, and the lack of participation in small caps. Give me a second here to go to the next one, which is going to be the bullish percent index, which is this one right here. So this is 2020 and 2021, and I wanted to share the 2 years because what happened in 2021, I think, informed a lot about what's happened recently with this indicator. I had Mark Chaikin on my show a couple weeks ago, and we were talking about some breadth indicators. We talked about bullish percent and some other indicators as well. If you look back at the history of this indicator, I'll share with you what it is here in a moment. You can see that overall it is basically a measure of market breadth using point and figure charts. And these purple highlighted areas have basically showed you every time in the last 2 years when the indicator has gone below 50%. 50% is this blue horizontal line that I drew in the top series. Every time it gets below 50%, this has been a pullback phase in the market. Every time it's gone right back above 50% in a week or so or less, that has been an incredibly viable dip, and the market has gone higher. Now, what this is actually doing is it's looking at 500 individual point and figure charts and saying, is the most recent signal a buy signal or a sell signal? If you don't understand bullish percent indexes, that's okay. I actually recorded a video on my YouTube channel a couple of weeks ago digging into this a little bit more, explaining how the point and figure charts are translated into a breadth indicator and a little deeper history than we have time for today. Go to my YouTube channel called Market Misbehavior if you want to check out that video. But here, what it's basically saying is when it gets below 50%, less than half of the S&P members are in a bullish phase. And that is a bit of a concerning pattern to emerge. So what that tells you is it's actually called a bear alert. When you get above 70%, come below 70%, you get below 50. And I think of that as a bearish phase. Getting right back above 50 in about a week or so, which is what you've seen in these 7 observations in 2025 and 2020, and 2 here in the last couple quarters of last quarter of 2021. It tells you it's a viable dip. And really all you've had to do is wait for this bullish percent index to turn negative and then pop right back up. And it's indicated this next leg higher in stocks. Now that works until it doesn't. And I think the concern is you have a repeat when it goes below 50%. It's hard to just buy right at that moment, because you can get a much steeper pullback, a much deeper drawdown. That's what happened in February, March of 2020. We broke 50%, ended up going all the way down almost to zero, single digits, with almost all the S&P charts, point and figure charts in a bearish pattern. But what you can see is, again, for most of 2021, we actually didn't even touch the 50% level, which tells you overall the breadth is supportive. We did go below it a couple times in October and December. And this chart reminded me that in a bull market phase, in a secular bull market phase, in a cyclical bull market phase, which I would argue we are still in, buying on the dips can be a very profitable methodology, as long as you have a way of systematically identifying those dips and having some risk measurement in place to recognize when it's not the case anymore. So this is a really important chart to tell the story of 2021 in terms of the overall strength of the uptrend. The fact that a lot of these dips have been Bible, and that is not a new phenomenon. That's actually what much of 2020 showed us coming out of the 2020 lows. Now, if you do a much deeper history, and again, the YouTube video I mentioned can do that for you. You can see there are actually 3 times since 2009 you've had a much deeper pullback, but there are many, many more of these briefer pullbacks on the bullish percent, which have been Bible pullbacks. That's what I'd be looking for going into January and into much of 2022. The next chart we will look at is this one, which is what I call the chart. and it's a measure of risk on versus risk off. And this is cheating in some ways, I guess, probably. And I used to joke because in my Fidelity days, I would ask everyone to bring one chart, which we would look at, and people would come up with so many ways to twist that. And try to pack as much information as they could on one chart. And I'm kind of doing that here. I'm cheating a bit, but this is combining some of the risk on versus risk off measures that I think told the story of 2021. Here we have the S&P 500 and top. This is the advanced decline line for the New York Stock Exchange. This is the equal weighted consumer discretionary versus consumer staples. Our investors on more offense or defense in the consumer space. This is the relative strength of the S&P 500 versus the utilities sector. If it's going down, that means utilities, a very defensive sector, are outperforming. These are new highs and new lows for the S&P 500, 52-week highs and lows. What you can see, though, is that this market in 2021, I think, has had sort of 3 phases. You have the first part of 2021, which is showing you stronger stocks, improving breadth, offense over defense, offense outperforming defense in terms of, utilities underperforming, and a healthy amount of new highs. That changed, though, quite a bit here in the middle of the year. And you can see over the summer, we have what's called the summer doldrums, where the market was going higher, but a lot of the breadth measures came off. This is when some of the cyclical sectors have been outperforming, and all of a sudden the growth sector starts to do well, and it's sort of a rotational experience. We're going to get to a chart here in a moment that speaks a little bit more to that rotational environment. You have less and less new highs. But if you look at what's happening now, you have the S&P stabilizing just below 4,700 on a closing basis, and all of these are rotating lower. When I think of the story of 2021, this is one of those years where so far it appears like we're going to finish the year in a position of weakness. And if it's not weakness at the high level, the S&P still remaining fairly high, you're seeing a lot of names that are breaking down. And that's what this risk off movement in the chart sort of speaks to. The advanced decline lines are not confirming these most recent swings higher. They're actually rotating lower. Consumer discretionary is underperforming consumer staples on an equal weighted basis. Utilities are outperforming, which is why this ratio line is going down. You are seeing still a healthy number, or a healthy enough number, of new highs, but overall, most of these measures are turning more risk off. And I think when I think of how 2021 played out with these Bible dips, this resilient uptrend, I think one of the big stories in 2021 is how this fourth quarter has played out, and really rotating more towards risk off. A lot of skepticism going into the end of the year, which is unusual. Usually November, December are the strongest parts of the year. We're not seeing that this year. The final one I wanted to show you is the, let's see, the 10-year chart. Where is that one? Dun, 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 dun. Here we go. We have the S&P 500 at top. This is the 5th chart to share with you, and then we're done. This is the relative strength of the financial sector versus the technology sector. This is the 10-year yield. We've talked enough about the last 2 years. And again, this is 2021 on the right half of the chart. But this 2-year period, I think, can be separated into 3 phases. In the first third, which is basically the beginning of 2021 through September, October of 2021, you have the S&P going through the 2020 pullback and moving higher, but you have financials underperforming technology consistently because the 10-year yield is going down. From September, October, November through really the end of the second quarter, you have rates going higher as the market's going higher, and you have the rates going higher and the financial sector outperforming going into when the banks peaked out in May. From May on, we have the market going higher. We have interest rates really sideways to down, and we have the financial sector underperforming. There's been sort of this, 8-month or so rotation to this ratio. I'm very interested to see if this ratio can go higher. I think when we think about a rotational environment, the fact that financials and technology have been changing sides in terms of which one's better or worse is very, very meaningful. And the reason why financials can outperform is if and when rates go higher. And that's what I would be looking for going into 2022 with the Fed and the prospect of raising rates. This is certainly, I think, probably the most important chart to understand leadership themes in 2021 and going into 22. Folks, that is our show for today. Thank you so much for joining us. Have a fantastic holiday season. We'll be back with you live in the new year. This is Dave Keller from StockCharts.com. Have a good one.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.